Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So I know I've mentioned on the show that I play ice hockey, and one of the things that we do as hockey players is we play hurt. Well, I'm playing hurt today. I am dealing with the ravages of the common cold, which I imagine you can probably hear in my voice. My throat's killing me. Not sure how long it's going to hold out, so this is going to be a little bit of a shorter show. But I definitely wanted to get something out there. I'm a dedicated servant of you, my listener. So here we are. So did y'all watch the Super Bowl? I did not. In fact, it's the first time that I have not watched the Super Bowl in many years. I actually played ice hockey, which was kind of dumb. I mean, why in the world did the rink schedule games during the Super Bowl? I don't know. But regardless, I really wasn't planning on watching the game anyway because I can't stand either of those two teams. So, did not watch. But, I guess there were some interesting things in the game. One little lesson is that sometimes records were meant to be broken, and sometimes they weren't. So, the Chiefs were going for the first ever Super Bowl three-peat, but could not pull it off with the Eagles winning the game. Meanwhile, the Eagles actually broke a record. Their 145 points was the most in a single postseason in NFL history. It broke the previous mark that was set by the 1994-1995 San Francisco 49ers. They scored 131 points, but they actually did it in fewer games. So, there you go. Speaking of the Super Bowl, here's another little tidbit for you. If you melted down the Lombardi Trophy, you'd get about 93.5 troy ounces of silver. Now, the trophy itself is not pure silver. It's a sterling, which is an alloy that is mostly silver, but I think there's a little bit of nickel or maybe zinc that's mixed in with it to give it some more strength. So, 93.5 troy ounces of pure silver in the trophy. At the price of silver on Monday morning after the game, the Lombardi Trophy, or the melt value of the trophy, was just over $2,990. Now, if you go back to last year, the value of the trophy melted down, just in terms of the silver, would have been $2,111 based on the price of silver at the time of the game. So that's a pretty good increase, right? It went from $2,111 to $2,990. So that just goes to show that despite the prevailing sense that silver kind of underperformed last year, it still wasn't exactly a slouch. And the increase in the value of the Lombardi Trophy, or the increase of the value of the silver in the trophy, underscores the value of precious metals, right? And it's important to remember, it's not so much that the Lombardi Trophy is more valuable, it's that the dollar is less valuable, right? The precious metals, gold and silver, they reflect the depreciation of our money. They're real money. They hold their value, but the dollar depreciates, so therefore the price of gold and silver go up. So you're seeing this constant devaluation of the dollar and this, over time, constant upward increase in the price of the metals. So this is exactly why, incidentally, that they're getting rid of the penny. President Trump announced, I think it was Sunday, that he was ordering the U.S. Mint to stop minting the venerable 1 cent piece. And again, the government has devalued your money. It's devalued your money to the point that the penny is basically irrelevant, right? If you're as old as I am, you remember penny gumball machines, right? Highlight of any trip to the mall with my grandparents. So get this, based on the CPI, prices have increased by over 713% since 1970. So I was like 3 years old in 1970. That was the height of my penny gumball buying years. The penny gumball that I bought when I was a kid now cost about 8.1 cents. So that shows you just how much the dollar has devalued, and of course, the penny and all of the other denominations along with it. On the other side of the coin, and pun was intended there, production costs for the penny have gone up due to that same inflationary pressure. So if you put all of it into perspective, it's no wonder it costs so much more to produce a penny than the penny is worth. But unlike fiat dollars, gold and silver are real money. They hold their value over time. You could buy a fine suit with an ounce of gold back in 1900, and today a fine suit still costs you about an ounce of gold because it retains its value and its purchasing power as money. So, we're talking about records today. If you saw the title of the show, it's Some Records Were Made to Be Broken, and we saw more record gold prices over the last week. In fact, we saw $2,900 an ounce gold this week. And that's the first time that the yellow metal has ever eclipsed that level. So we're actually pushing towards $3,000 gold, and that's right in the crosshairs. In fact, I did an article this week pointing out that a couple of the big banks, Citigroup and UBS, have both upped their gold price projections for 2025, and they're targeting $3,000 an ounce gold. And of course, in my opinion, these big banks and the mainstream analysts, they miss a lot of the things that are actually driving gold higher. So I consider any kind of big bank estimate to be conservative. So keep that in mind. But did you realize that gold set price records 40 times in 2024? We had 40 record highs last year. And gold set another record in 2024, a record for demand. And that actually surprised me a little bit given the higher prices, because generally high prices drive demand down somewhat, especially in the jewelry market, in that retail gold market. And Eastern gold buyers tend to be more price sensitive. So I was wondering if we would actually see a demand record, but it happened. And the demand in certain areas, primarily central bank gold buying and investment, was so strong that it actually overcame the gravity of higher prices that did in fact pull down demand in the jewelry sector. So I'm going to break the demand numbers down a bit for you because I think there's some important tidbits for you as somebody who's interested in gold and silver and investing. So looking at the overall data, and this is based on data compiled by the World Gold Council, total gold demand in 2024 rose by 1% and set a new record of 4,974 tons. So the world consumed just under 5,000 tons of gold last year. The combination of record high prices and this record demand volume drove the demand in value terms or in dollar terms to its highest ever level, and that was $382 billion. By far, the biggest driver, I think, has been central bank gold demand. And we've seen strong central bank gold buying for several straight years. Global gold reserves grew by over 1,000 tons for the third straight year. Now, to put that into some perspective, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. So, basically, this 1,000 ton plus demand is more than double what the average was in the decade between 2010 and 2020. On net, central banks increased their gold holdings by 1,044.6 tons last year. So when I say net, that's taking account all of the gold buying that was reported and then subtracting all of the gold selling, which quite frankly, there wasn't very much selling at all. It was the 15th consecutive year of expanding gold reserves. It was the third largest expansion of central bank gold reserves on record. It was just 6.2 tons lower than 2023, which is the number 2 year. And then it was 91 tons lower than the all-time record high central bank gold demand, which was back in 2022. And as you think about these official gold reserve numbers, take into account that a lot of not a lot, but some central banks add unreported gold, right? Some, they'll wait a long time before they report increases or decreases. And then there are some who just kind of buy under the table. For instance, the People's Bank of China quietly purchased over 100 tons of gold in October and November alone, right? In October, supposedly the Chinese weren't buying gold at all, and that was kind of big news, but they were buying it secretly. And we've got some good articles and reporting on that over at moneymetals.com/news. I'll link to at least one of those articles in the show notes. So the World Gold Council includes an estimate of unreported gold buying in their data. So if you actually add up all the numbers that they report, you'll find that over 1,000 tons is actually more than what you'll add up. But I don't think that the unreported buying that the WGC estimates actually captures all of the unreported buying. I think there is more going on under the table, again, particularly in China. I think China is stockpiling gold much faster than they're reporting, kind of, again, secretly and under the table. Anyway, we can't know that for sure. I mean, I think we've made a pretty good case for it because there's a way to extrapolate that data. But for the sake of argument now, we'll just go with these official numbers that are compiled by the World Gold Council. And if we go by those numbers, the biggest central bank buyer last year was the National Bank of Poland. It added 90 tons of gold to its reserves. And then we had Turkey and India, who were number 2 and number 3. And then China was 4th, despite not reporting any increases to its gold reserves for like 6 months. So it bought a lot of gold early in the year, stopped reporting, kept buying gold under the table, and then started reporting again. I think it was in November. So we saw some additions to their official reserves in November and December. I think it's interesting. The Polish central bank governor, he kind of summed up why so many countries are stockpiling gold when he announced plans to expand the country's reserves a few years ago. And he said this. He said, gold will retain its value, even when someone cuts off the power to the global financial system, destroying traditional assets based on electronic accounting records. Of course, we do not assume that this will happen, but as the saying goes, forewarned is always insured, and the central bank is required to be prepared for even the most unfavorable circumstances. That is why we see a special place for gold in our foreign exchange management process. And he also pointed out that, quote, gold is free from credit risk and cannot be devalued by any country's economic policy. Besides, it is extremely durable and virtually indestructible. So he really sums up the positives of holding gold as a financial reserve. And the things that he says are every bit as true for individuals as they are for central banks. So something to think about as you're balancing your own personal portfolio and trying to preserve your own wealth. Now, he talks about somebody cutting off the power to the global financial system. And the way he couched it sounded like he was talking about like literally shutting off the electricity. And, that is certainly something that is possible when you live in a world that is completely dependent on digital money. Not completely, but virtually. In fact, I looked this up the other day because I was doing that article on the penny. And did you realize that only 16% of transactions in the U.S. were done in cash? I think that was based on 2023 numbers. So almost all of our financial system is digital. So when he talks about somebody turning off the electricity or shutting off the power, that's certainly possible. But I think a lot of countries have become even more wary of the U.S. With the aggressiveness of sanctions against Russia. And in a sense, the U.S. and its Western allies have basically cut off the power of the financial system in Russia, right? They have locked Russia out of the SWIFT financial system. It makes it difficult for them to do business around the world. They've tried, at least, to cut Russia off from the rest of the world economically as a punishment for its invasion of Ukraine. And interestingly, gold is one of the reasons the Russian economy has actually been able to keep plugging along. I wrote an article about this a while back, the fact that they've used their gold reserves directly and indirectly to support their economy since they've basically been cut off from the dollar. And, think about this. If somebody has something over you that makes you vulnerable, what do? Well, you try to minimize that thing, right? So if you know the U.S. could use dollars against you, wouldn't you minimize your exposure to dollars? And I think this explains at least part of the motive for this central bank gold buying. It's de-dollarization. They're trying to diversify their reserves. They want to know that if the U.S. gets angry with them for something or, wants to motivate them to a certain foreign policy position based on threats of sanctions, well, they want to have a way to kind of counteract that, and holding gold is one way to do it. And then there's also the fiscal side of the coin, the fiscal malfeasance in the United States, the constant borrowing and spending and the ever-growing debt. We have this massive national debt, and at some point, you have to start wondering, should I keep lending money to this hobo? And I have to think that there are, some officials in some countries that are nervous. I know they are because I read about it. They are nervous about the trajectory of the United States' finances. I was talking to Greg Weldon, who's a really good analyst, and you'll be able to listen to that interview on Friday on our Market Wrap podcast. And one of the things that we talked about was the fact that it now takes more than $1 of debt to generate $1 of GDP growth. So we're almost in, he called it a black hole, where the gravity is sucking us in, where you have to keep issuing more and more debt because that's the only way you can continue to expand the GDP. Well, obviously, that's not a sustainable situation. And again, I think a lot of countries recognize this. They recognize the threat to the dollar. And we can certainly be optimistic with Doge and some of the waste that's being rooted out of the government spending. But the fact of the matter is, you're not going to really deal with the borrowing and spending problem until you tackle the biggies: national defense, Social Security, Medicare. That's where the bulk of the money and the spending is going, not to mention the fact that we're spending over $1 trillion a year just servicing the national debt. So it's a much bigger problem than just, cutting out payments to, Politico out of USAID. There's a lot more to deal with. And I think a lot of countries realize that. They're worried about the dollar, and so they're getting gold. So bottom line is, I don't think you're going to see central bank gold buying slowing down anytime soon. On a little side note, a couple of people who read my report on central bank gold buying asked why the U.S. wasn't even on the list of gold buyers. Well, the U.S. hasn't reported any substantial changes to its gold reserves since President Nixon severed the last tie to the gold standard. So basically, the U.S. reserves have been unchanged, at least as far as we know from official reports. The U.S. holds about 8,133 metric tons of gold, which makes it by far the biggest gold holder in the world. Now, there is some question about whether that gold happens to actually still be there or not. Is it sitting in the vaults in Fort Knox? I don't tend to get real into conspiracies like the gold is gone. But the fact of the matter is that the auditing that's been done, there are questions. It is fair to wonder that. And, who knows? Who knows, right? But we'll, again, just for sake of argument, we'll go by the official numbers. And if we believe that, then the U.S. is the biggest gold holder in the world, but it hasn't actually bought any gold for a long time. So anyway, looking at some of the other gold demand categories, investment gold. investment in gold hit a 4-year high, coming in at 1,179.5 tons, and that was a 25% annual increase. So a really healthy increase in gold investment. Kind of makes sense if you think about it. You've got gold on this bull run. That makes people excited, and they're more apt to say, maybe I should get some gold in my portfolio now as it's going up. I would argue that it would be smarter to have that gold in your portfolio already that you bought at a much cheaper rate, a while back. But, you got to sometimes get in where you fit in. So there you go. The wild thing about the investment demand is virtually all of it was in the East. And it's interesting because we saw a shift in buying. Coin sales actually fell by 31% last year, as bar sales grew by 10%. And that kind of reflects the overall investment demand trend. Asian investors tend to favor gold bars. Western investors tend to favor coins. And the fact that most of the demand was in Asia and in the East kind of is evidenced by the fact that it was gold bars that really showed the big increase. Just kind of looking at some of the individual countries, bar and coin demand in India grew by 29%. And Indian demand got a big boost from a cut in the excise tax that went into effect in July. People who say that, tax cuts don't incentivize anything, all you got to do is go look at the gold demand in India before and after this big excise tax cut went into effect. The lack of higher taxes incentivized more gold buying. It's just, it's one of those economic realities that sometimes people like to pretend don't exist, but they really do. Chinese physical gold demand hit its highest total in a decade. It rose by 20%. Then, meanwhile, here in the U.S., bar and coin demand fell by 33% and hit its lowest level since 2020. And then retail gold demand hit a 17-year low in Europe, so falling in half from an already low base back in 2023. So I think that's just really interesting to look at that almost all of the physical investment demand was centered in China, India, Vietnam, North and South Korea, Singapore, in those Asian countries. And here in the West, everybody's kind of like, we don't really need gold, even as it's setting 40 record highs in a single year. ETF investing, so investing in gold through ETFs, and these are basically funds that are backed by gold. They trade on the stock market just like stocks, and it's a way to play the gold market without actually holding physical metal. ETF investing rebounded in the second half of last year, with funds reporting net gold inflows for the third and fourth quarters. Now, for the entire year, there was a slight outflow of gold from ETFs. And again, I think this reflects kind of this tepid investment demand, kind of lack of interest in the United States and in Europe, because again, that's where you tend to see most of the action in ETFs. So it was a 7-ton outflow for the year. So basically started if you kind of look at the trajectory, it started the year, a lot of gold was flowing out of ETFs, and then we got to the back half of the year, we saw a lot of gold flowing back in, but not quite enough to compensate for the outflows earlier in the year. So after sinking to a 4-year low of 3,080 tons in April, ETF gold holdings recovered throughout the remainder of 2024. And again, they ended the year very close to where they started. Now, looking at jewelry demand, I mentioned the fact that this is where you would expect to see a hit in demand due to higher prices. And in fact, that's what we saw. An 11% drop in gold jewelry demand to 1,877 tons. Interestingly, though, while the high prices did create a lot of headways in the jewelry market, high prices drove the total value of jewelry demand up by 9% to $144 billion. So people actually spent more on gold jewelry, but they didn't buy as much in volume. So except for 2020, at the height of the pandemic, jewelry demand in volume terms was at the lowest level since the Great Recession back in 2009. China actually drove the demand weakness, and I had read earlier in the year that Chinese buyers, especially in the jewelry sector, tend to be very price sensitive, and that was definitely true. We had a 24% drop in jewelry demand in China. It was the second time in 3 years that China has ceded its position to India as the largest jewelry market. And something people should be aware of, when we talk about jewelry investment in China and India in particular, it's not like jewelry here. It's not like, you go to K's or wherever and get something pretty. In India and China, gold jewelry is also considered savings. It's considered an investment, and they tend to buy 24 karat gold jewelry that is of the same purity as what you would get in a gold bullion coin. And so it's not like the 14 karat gold that you get here in the United States. So it tends to be more valuable, more pure gold, and viewed not only as something that we want to wear because it's beautiful, or give as a gift, but it's also considered an investment. So there's a little bit different mentality in the East in terms of gold jewelry. Indian gold jewelry demand was also down, although much more modestly at just 2%. And it had a very strong third quarter. In fact, it was the strongest third quarter for jewelry demand in India since 2015. And again, this reflects that cut in the gold import tax. Going to the United States, jewelry demand was also pretty tepid. The market actually reported its 11th consecutive quarter of declining demand in volume, and it pushed annual jewelry purchases to a 5-year low. However, again, rising prices pushed the value of U.S. jewelry demand to a record high of $10 billion. So people were spending more on jewelry, but getting less of it because of the higher price. Another area of gold demand to look at is in technology, and this is a much smaller segment of demand than investment or jewelry. But it is significant in its own way. And we saw a 7% increase in demand for gold in technology to 326.1 tons. The use of gold in electronics increased by 9% to 270.6 tons. So most of this industrial demand is coming from electronics, computing, those types of things. The surge of AI has really helped boost both silver and gold industrial demand because AI applications take a lot of computing power. Computing power requires metals with low resistance and good electronic or electrical conductivity, and gold and silver both fit the bill. There was also some recovery in the consumer electronics market after a weak year in 2023. Global demand for gold in other industrial and decorative applications fell by 4% in Q4, and this was driven by sagging demand in Italy and East Asia due to slow sales of branded accessories, destocking by retailers. Looking at the plus side, Indian demand grew by about 5% as high gold prices impacted the affordability of fine jewelry, and that increased demand for gold-plated articles and gold-plated jewelry. So you're seeing some substitution due to the high prices. So when you kind of look at the demand for 2024, you kind of put it all into perspective. I think the most interesting aspect of this story is the fact that we've seen this big bull run in gold. Again, 40 record highs in 2024. Just a really, really strong year for gold. And we saw this with very little participation from the West. It's been driven by emerging market central banks in Asia and Eastern Europe, and by investors in Asia, particularly India and China. Now, imagine if U.S. and European investors hop on that bandwagon. If we can maintain this demand in the East and then the West engages, that could create another significant leg up for gold. And I think that's going to happen at some point. I think Western interest is going to come back. We saw it a little bit in January. For the first time in ages, we saw a big inflow of gold into ETFs in Europe. And European gold funds have been bleeding gold for months and started to kind of turn around a little bit in December. And then again in January, Europe had the strongest level of inflows of all of the regions. So maybe we are starting to see some kind of wake up here in the West in terms of demand. But again, you've got the impact of monetary malfeasance really hasn't manifested yet. We had the little bout of price inflation. It got up to 9.5%, and that was bad. But we still really haven't seen the impact of more than 2 decades of artificially low interest rates, of all of those rounds of quantitative easing after the Great Recession, and again at the pandemic, where they created like some $8 trillion of new money and injected into the economy. And then they've raised interest rates in a world that has been incentivized to pile up all of this debt. I mentioned the fact that we're at the point now where it takes more than $1 of debt to create $1 of GDP. That was all incentivized by central banks. Central banks, with their easy money policies, incentivize borrowing, and that's why everybody is so desperate for rate cuts right now, even though inflation is still relatively hot, because they know that this bubble, debt-riddled economy can't function in that higher interest rate environment. And we haven't seen all of those chickens come home to roost yet. And I think when they do, that's when you're going to really see people in the West start jumping on the gold bandwagon. I think there's still a lot of upward space for gold. And of course, then you've got silver, which is still showing a gold silver ratio over 90. And again, talking to Greg just the other day, Greg Weldon, he thinks that we're going to finally start to see this gap closed. So a lot of interesting things out there. If you want to jump in early, this is a great time to call a Money Metals precious metals specialist. You can dial 800-800-1865 and get some gold, get some silver. This is the time. You don't want to keep waiting. I obviously, at any time you could have a buying opportunity with a sell-off, a correction, but I don't see any sustained drop in gold given the macroeconomic dynamics here in the next months ahead. So if you're interested in investing in precious metals, give them a call today. If you're thinking, I just don't have a lot of money right now to put into gold and silver, it's expensive, we have an actual monthly installment plan where you can buy gold just on a monthly basis. Every month you put in a certain amount. It could be just, $200, and you can build a precious metals portfolio over time. So that's an option. And you can talk to a precious metals specialist at 800-800-1865. If you don't want to talk on the phone, you can always go to moneymetals.com and simply chat online. Or if you know what you want, you can buy all of our products online. You can check out our specials. Everything is right there at moneymetals.com. So I'm going to sign off. I made it through. I didn't have any massive coughing fits, although I'm really close. So let's call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up to get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you can tune into our Market Wrap podcast every Friday. As I said, this week I talked to Greg Weldon, and a really good conversation with him. You'll get a quick overview of the week in precious metals on that show, and then conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. I appreciate you listening to the show, and I apologize for whatever rambliness and grossness that you heard in my voice. Hopefully we'll get some rest and get better and be back next week ready to roll. again. So thanks again for listening, and I'll talk to you again next week.